Hello everyone, and welcome back to Building Business Plans and Structures. In our previous classes, we touched upon the basics of cash flow projection in Chapter 4. Today, we will dive deeper into this critical aspect of financial planning. Understanding cash flow projection is essential for managing your business's financial health and planning for future growth. So what exactly is a cash flow projection? A cash flow projection is an estimate of the amount of money you expect to flow in and out of your business over a specific period, usually 2 to 5 years. It helps you plan for future expenses, manage cash shortages, and make informed financial decisions. Here are the steps to perform a cash flow projection. Step 1. Collapse your data. In order to start making your cash flow projection, you need to collapse your data to make it more manageable. Categorize all portions of the income statement and balance sheet into multiple sections with 5 to 7 entries. This way, it is way more manageable and therefore easier to work with. For example, operating expenses would be made up of selling, wages, benefits, overhead, rent, general and administrative, and depreciation. Try to fit all operating expenses into a similar group of categories. Step 2. Add your historical values. Add your previous balance sheet and income statement data into the spreadsheet, and make sure to have 2 to 3 years of historical data. If it's currently in the middle of the year, you must estimate the rest of the year by dividing the wanted number by a proportion of months until the end of the year. For example, if it is August, which is the 8th month of the year, you would do 8 divided by 12. Then, if you want to estimate a certain number, it would look like this. Step 3. Build your assumptions. Determine the benchmarks for each of the listed items. Things that will be known, such as rent increasing by 10% each year, should be listed. If unknown, use historical data to determine a reasonable percent change or use inflation rates. If you use a service such as LivePlan, you can make these assumptions based on similar businesses within your industry. Step 4. Flush out your future years. Combining the historical data with the benchmarks will project future cash flows. Evaluate the projected numbers and use them to guide business operations. Here are some key tips. Be realistic. Use multiple scenarios. This can mean having scenarios in which revenue grows by a bigger or a smaller percentage. Same with expenses. Review and adjust regularly. Make sure to adjust them whenever something changes within the marketplace or within your business. How often should a business update its cash flow projections? It is recommended to update cash flow projections at least quarterly or whenever there are significant changes in the business environment. Can cash flow projections help in securing financing? Yes. Accurate cash flow projections can help demonstrate financial viability to potential investors or lenders. What are some common mistakes to avoid? Avoid being overly optimistic, neglecting to account for all expenses, and failing to regularly review and update projections. To conclude, we've covered the essentials of cash flow projections, including their structure and how to create realistic assumptions. By understanding and managing your cash flow, you can make informed financial decisions and ensure the long-term success of your business. Until our next class, start creating your cash flow projections using the framework we've discussed today. Remember to follow the steps outlined in this presentation. Thank you for joining me today. Your participation and questions were invaluable. I look forward to our next session together, where we will continue to build on this foundation. If you have any questions or need further assistance, please feel free to reach out. Have a great day and happy planning.